Welcome to LuckScout Economic News. The economic landscape of the United States is currently marked by a blend of burgeoning challenges and emerging opportunities. As the Federal Reserve grapples with pivotal decisions, the ripple effects are felt across various sectors. The recent uptick in oil prices compounds the complexity, influencing inflation and consumer spending patterns. This essay aims to dissect these phenomena, providing a clear picture of the interplay between monetary policies, market reactions, and the broader economic impacts. Amidst these economic dynamics, the labor market presents a paradox of robust job additions contrasted with underemployment and wage stagnation. Furthermore, the service sector, a significant contributor to the GDP, is experiencing a noticeable slowdown, raising concerns about the sustainability of consumer-driven growth. Understanding these intricate details is crucial for both policymakers and investors. In this context, the role of the Federal Reserve and its interest rate policies becomes even more critical. As we delve deeper into these issues, it is essential to consider the broader implications on personal and institutional financial strategies, laying the groundwork for informed decision-making in an uncertain economic environment. The Federal Reserve's role in shaping economic conditions through its monetary policies cannot be overstated. Recently, the Fed has been navigating a tricky balance between curbing inflation and fostering economic growth. Interest rate decisions, a primary tool in their arsenal, have been adjusted in response to fluctuating economic indicators. These decisions directly impact lending rates, consumer spending, and business investments, making them a focal point for economic analysis. In the current economic setting, the Fed's inclination towards incrementally raising interest rates is aimed at tempering the inflationary pressures without stalling economic growth. This cautious approach reflects the complexities of achieving a soft landing, a scenario where inflation is controlled without triggering a recession. The implications of these policies are widespread, affecting everything from mortgage rates to business loans, ultimately influencing consumer and business behaviors. As we further explore these policies, it's important to understand that the Fed's decisions are often anticipatory, based on projections and economic forecasts. They serve as preemptive measures to steer the economy towards desired outcomes, necessitating a deep dive into economic data and trends for a comprehensive understanding. Lastly, these policies do not operate in isolation. They interact dynamically with other economic variables, such as employment rates and international trade dynamics, creating a complex web of influences that shape the overall economic environment. Understanding this interplay is crucial for predicting future economic conditions and making informed financial decisions. The recent surge in oil prices has been a significant driver of inflationary pressures, affecting economies worldwide, including the USA. Oil, as a critical input in various industries, from transportation to manufacturing, influences the cost structures of myriad businesses, which in turn affects consumer prices. This linkage makes the oil price a crucial variable in the economic equation, particularly in its capacity to influence inflation rates. The direct impact of rising oil prices is seen in increased transportation and production costs. These costs invariably trickle down to consumers, leading to higher prices for goods and services, thereby fueling inflation. This inflationary spike complicates the Federal Reserve's task of managing economic stability, as it strains consumers' purchasing power and can lead to decreased spending and economic slowdown. Moreover, the geopolitical landscape often influences oil prices, adding an element of unpredictability that can exacerbate economic volatility. The interconnections between oil prices, geopolitical stability, and economic outcomes are profound, requiring nuanced understanding and strategic foresight. In addition, the response to rising oil prices isn't just about economic adjustments, but also involves strategic considerations in energy policy and sustainability efforts. As such, analyzing the impact of oil prices extends beyond immediate economic effects to encompass broader strategic and policy implications, crucial for long-term economic planning and stability. The labor market in the United States currently presents a complex picture, characterized by mixed signals that puzzle economists and policymakers alike. On one hand, robust job creation suggests a strong labor market, contributing to consumer confidence and spending. On the other hand, aspects like wage stagnation and underemployment indicate underlying weaknesses that could undermine long-term economic stability. This dichotomy can be partly attributed to the changing nature of work and the gig economy's rise, which, while offering flexibility, often leads to less stable employment conditions. Such developments affect spending and saving patterns, influencing overall economic activity. Additionally, technological advancements and automation continue to reshape job profiles and skill demands, further complicating labor market dynamics. Moreover, the labor market's condition significantly impacts the Federal Reserve's policy decisions. A strong labor market could give the Fed leeway to raise interest rates without fear of increasing unemployment, whereas signs of weakness might caution against such measures. Understanding these dynamics is essential for anticipating the direction of monetary policies and their broader economic implications. Lastly, the labor market's health is a critical indicator of economic resilience. A deeper analysis of employment trends and workforce adaptability in the face of economic shifts is crucial for assessing future economic prospects and crafting policies that ensure long-term economic health and stability. The service sector, a cornerstone of the United States economy, is experiencing a noticeable slowdown, which raises several concerns about the overall economic momentum. This sector, which includes industries from hospitality to finance, significantly influences economic growth and employment levels. A slowdown in this area can have widespread effects on the economy, from reducing consumer spending to impacting the GDP growth rate. Factors contributing to this slowdown include decreased consumer confidence, changes in consumer spending habits, and broader economic uncertainties. As consumers become more cautious with their spending, service-oriented businesses face reduced revenue, leading to potential cutbacks and layoffs, further exacerbating economic slowdown. Moreover, the service sector's health is a bellwether for the economy's overall condition. It reflects consumer sentiment and economic trends, making it a critical area of study for understanding economic cycles. The current slowdown prompts a re-evaluation of economic strategies and policies aimed at revitalizing this vital sector. In addition, the implications of this slowdown extend beyond immediate economic metrics. They touch on aspects of economic inequality and regional disparities, as different areas and demographics may be affected disproportionately. Addressing these challenges requires comprehensive strategies that consider fiscal, monetary, and social policy tools to rejuvenate this pivotal sector, and, by extension, the broader economy. In the face of economic uncertainties, adopting strategic investment approaches is crucial for safeguarding assets. One effective strategy is investing in short-term bonds. These instruments offer lower risk and stable returns in volatile markets. Another strategy involves focusing on high-dividend stocks. Companies that pay dividends tend to be in stronger financial health, providing a steady income stream. Global diversification is also critical, offering exposure to different economic cycles. Investing in markets outside the U.S. reduces the risk of concentration in any single market. Finally, real estate investments can hedge against inflation, with property values and rental income typically rising. As the United States economy navigates through a period of significant flux, characterized by Federal Reserve policy shifts, volatile oil prices, mixed labor market signals, and a service sector slowdown, the importance of informed and strategic financial planning cannot be overstated. Understanding these complex dynamics is crucial for both individual investors and financial institutions, aiming to optimize their financial strategies in response to an ever-changing economic landscape. The insights gained from examining these factors should guide the development of robust financial plans that are resilient in the face of economic uncertainties. Implementing strategies such as investing in short-term bonds, focusing on high-dividend stocks, diversifying globally, and considering real estate investments can provide stability and growth potential in turbulent times. Moreover, as economic conditions evolve, continuous monitoring and adaptability become paramount. Staying informed about economic developments and adjusting investment strategies accordingly is essential for achieving long-term financial security and success. In conclusion, by understanding the intricate relationships between various economic indicators and market forces, individuals and businesses can better prepare for future challenges and opportunities, ensuring a stable and prosperous financial future in a dynamic economic environment. Please like the video and share it with others. Thank you for watching.